In the years leading up to every market catastrophe, there exists a pattern, subtle, almost invisible to the masses, yet glaringly obvious to those who watch the tides of capital. In 1929, Joseph Kennedy executed 3 trades 6 months before the collapse. Trades that would shield him from ruin and multiply his fortune while the world around him burned. He converted his stock holdings into cash. He purchased gold. He positioned himself to profit from volatility. When the market plummeted 89%, Kennedy walked away with $50 million, an astronomical sum in any era, while countless investors watched everything vanish in weeks. Fast forward to 1987, Paul Tudor Jones mirrored the same 3 trades. On October 19th, when the Dow tumbled 22.6% in a single day, Jones pocketed $100 million. The market was in freefall, panic reignited, and yet his foresight turned disaster into windfall. In 2008, a new cast of players, Michael Burry, John Paulson and others, executed these trades with surgical precision. They converted to cash, purchased gold, and positioned for volatility through derivatives that were practically invisible to ordinary investors. When the financial system imploded, they amassed fortunes while the global economy teetered on the edge. And today, in 2025, the same pattern is unfolding. Warren Buffett, Ray Dalio, and Bill Ackman, titans of capital, are executing the very same 3 trades. Not 4, not a dozen. 3 trades that have anticipated every major market crash in the last century. This is not luck. It is the mechanical rhythm of markets, a repetition born from human behavior, leverage, and greed. Crashes follow a sequence: extreme valuations, excessive leverage, a trigger, forced liquidation, and panic. Those who understand this pattern act decisively, making the same 3 trades each cycle. Let us examine why these trades, specifically, hold the key. First, the recognition phase. Smart money sees valuations stretching beyond rational limits. Risks outweigh potential rewards. They exit, converting positions to cash, preserving capital before the inevitable collapse. Second, the wealth preservation phase. Cash alone is vulnerable. Inflation and currency devaluation gnaw at its purchasing power. Gold becomes the fortress, a time-tested hedge against systemic decay. Third, the profit phase. Wealth is not merely protected, it is amplified. Volatility instruments, put options, and credit default swaps reward those who anticipate the storm. Together, these trades create a triad: protection, preservation, profit. Trade 1. Cash conversion. This is the earliest signal, 12 to 18 months before the market unravels. In 1929, Joseph Kennedy, a master speculator of the Roaring Twenties, had controlled massive positions across multiple stocks. The market was euphoric. Prices had tripled in 5 years. Margin debt soared to record levels. Investors were buying stocks with borrowed money, often 90% of the value financed by banks. Kennedy understood the peril. When everyone is leveraged, there are no new buyers. Any minor decline triggers margin calls, cascading into a death spiral. By the summer of 1929, he methodically converted his holdings into cash, spreading sales to avoid disrupting the market. By September, the Dow peaked at 381. 7 weeks later, the market crashed on Black Thursday. Kennedy was safe, ready for the next move, while the public lost fortunes overnight. In 1987, Paul Tudor Jones, running a successful hedge fund, recognized eerily similar signals. The Dow had soared from under 1,000 in 1982 to over 2,400 by August 1907. Price-to-earnings ratios were stretched. Margin debt was surging, and new program trading, computer-driven, automated large-scale trades, introduced unprecedented instability. Jones anticipated the inevitable crash. Throughout August and September, he reduced long positions, converted to cash, and communicated clearly with investors, predicting a major correction in October. By early October, he was fully prepared. 17 days later, the market collapsed. 2008 brought a different complexity. Michael Burry foresaw the housing bubble. As early as 2005, he raised cash, stopped conventional investments, and readied the subsequent trades. John Paulson recognized the same risks in 2006 and built a fund to bet against subprime mortgages. Even Warren Buffett, the ever-conservative investor, had grown Berkshire Hathaway's cash reserves from $40 billion in 2006 to over $60 billion in 2007. By the peak in October, these investors were substantially in cash, insulated from the accelerating collapse of the financial system. And now, 2025, Buffett sits on a record $325 billion in cash. Corporate insiders are selling stock at levels reminiscent of 2007. Jeff Bezos, Mark Zuckerberg, Jamie Dimon, executives at the helm of major corporations, are offloading shares, signaling what they see in the data others cannot. Valuations are stretched, debt is unsustainable, the cycle is late stage. The first trade is active. The exit to cash is underway. Trade 2. Gold accumulation. This runs concurrently with the first trade. While cash preserves capital, gold safeguards purchasing power against inflation, devaluation, and central bank interventions. In 1929, Bernard Baruch converted substantial holdings to physical gold, anticipating not just deflation, but the eventual revaluation of currency. By 1934, when Roosevelt devalued the dollar from 20.67 to $35 per ounce of gold, Baruch's foresight rewarded him handsomely. In 1987, gold played a protective role, appreciating as markets panicked. By 2008, it became essential. As the Federal Reserve printed unprecedented amounts of money, gold surged from $600 to over $1,900 by 2011, preserving and amplifying wealth for those who had positioned early. Today, central banks are buying gold at record rates. China, Russia, India, Turkey, Poland, Singapore, all accumulating gold, diversifying away from the dollar. Billionaires like Ray Dalio, Stanley Druckenmiller, and Paul Tudor Jones hold gold strategically. Its price is hitting record highs. This is Trade 2 in motion, securing wealth while the system teeters. Trade 3, the volatility bet. This is the phase where preservation transforms into profit. Trade 1 shields you from losses. Trade 2 maintains purchasing power. Trade 3 generates extraordinary returns as the market collapses. In 1929, after Kennedy converted his holdings to cash and Baruch accumulated gold, the next step was to profit from the inevitable collapse. Shorting stocks, the mechanism of choice, allowed Kennedy to sell borrowed shares at elevated prices and repurchase them at a fraction after the crash. While stocks continued to rise modestly through September, he paid the cost of holding these positions, confident that the eventual collapse would deliver outsized returns. And when October arrived, the Dow plunged, allowing him to cover his shorts at far lower prices, earning an estimated $15 to $50 million, a fortune equivalent to several hundred million today. Paul Tudor Jones's execution in 1987 was even more meticulously documented. After raising cash and acquiring gold, he purchased massive numbers of put options on stock index futures. Put options confer the right to sell at a set price, essentially a bet on decline. When the Dow fell 508 points on October 19th, Jones's options multiplied in value. His fund gained 62% that month alone. Cameras captured him on the phone, making millions in real time. It was a masterclass in timing and discipline. The 2008 financial crisis escalated the complexity of Trade 3. Michael Burry and John Paulson could not short mortgages directly. The instruments didn't exist. Instead, they innovated. Credit default swaps, essentially insurance contracts against bond defaults, became the weapon of choice. Bury paid premiums for years, often frustrating investors as the housing market continued to rise. But the moment defaults accelerated, the swaps paid out massively. Bury's fund earned over $700 million. Paulson, executing the strategy at an unprecedented scale, collected $15 billion across his funds, personally netting $4 billion. Years of small premiums culminated in the largest payouts in hedge fund history. And now, in 2025, the same playbook is being executed. Credit default swaps on commercial mortgage-backed securities have spiked 300 to 500% since 2021. Put options on major indices and VIX calls, bets on surging volatility, are being purchased by institutions. Bill Ackman has signaled he is positioning similarly to his 2020 trade, where he turned $27 million into $2.6 billion. These are not speculative whims. They are precise responses to economic mechanics. Leverage in commercial real estate is stretched. Offices sit half empty. Mortgages at 3% face refinancing at 8%. Defaults are mathematically inevitable. The instruments may differ, derivatives instead of shorted equities, but the principle remains identical. Anticipate collapse. Pay the small cost now, reap massive profits later. This triad, cash, gold, volatility, is not random. It addresses every stage of a crash. Trade 1 protects during the initial descent. Trade 2 shields from currency risk and monetary inflation. Trade 3 profits from the market's full collapse. Across nearly a century, the pattern repeats with uncanny precision. 1929, 1987, 2008, and now 2025. Each cycle, the same mechanical responses. Understanding the crash sequence illuminates why these trades work. Every major crash begins with a bubble. Assets disconnected from fundamentals, propelled by excessive optimism. In 1929, stocks traded at absurd multiples, fueled by speculative pools and easy credit. In 1987, program trading and leverage amplified already stretched valuations. In 2008, fraudulent lending and mortgage-backed derivatives inflated housing prices to unsustainable heights. In 2025, the Buffett indicator suggests stocks are nearly double GDP, a historic extreme. Euphoria follows. In 1929, even shoeshine boys speculated on stocks. In 1987, the market believed computers guaranteed endless gains. In 2008, Americans assumed housing prices could never fall nationally. In 2025, artificial intelligence, crypto, and new technologies dominate the narrative. Optimism blinds rational analysis. Leverage magnifies these gains. Borrowing becomes routine. In 1929, investors bought stocks on 90% margin. In 1987, synthetic leverage via portfolio insurance escalated risk. In 2008, derivatives amplified exposure 50-fold. In 2025, margin debt nears record highs, echoing the extremes of prior cycles. Then comes the trigger. A seemingly minor event ignites a cascade. In 1929, it was a European financial scandal. In 1987, interest rate hikes and program trading failures. In 2008, rising subprime defaults. In 2020, potential triggers include commercial real estate defaults, corporate collapses, or geopolitical shocks. The trigger itself is almost irrelevant. What matters is that it initiates forced liquidation. Leverage forces investors to sell, cascading losses into a death spiral. Stage 5. Forced liquidation. Stage 6. Panic. Prices collapse as fear overtakes logic. Liquidity evaporates, bids vanish, and volatility spikes. Market drops of 20 to 40% in weeks are not uncommon. And it is precisely at this moment, panic and chaos, that the three trades pay off. Trade 1. Cash shields against forced selling. Trade 2. Gold preserves wealth against inflation and currency debasement as central banks scramble to stabilize the system. Trade 3. Volatility instruments multiplies wealth as the panic unfolds. This is why these trades are timeless, why history repeats with mathematical precision. Where are we now in 2025? Late-stage positioning. Trade 1, nearly complete. Buffett's $325 billion in cash, insider sales, record levels of corporate divestment, all signal that smart money has exited. Trade 2, accelerating. Central banks accumulating gold, record prices. Trade 3, being established. Credit default swaps, index put options, VIX calls, bets on the market's collapse are actively being placed. The sequence is in motion. Based on historical cycles, the crash is expected within 12 to 18 months. Late 2025 into 2026 appears most probable. A trigger could accelerate this, or irrational market optimism might extend the window slightly. But the signs are clear. Cash is being raised, gold is being accumulated, volatility bets are being positioned. History is repeating itself. When the crash hits, the scale will be staggering. Markets could fall from current levels around 6,1600 on the S&P 500 to near 3,500 or lower. Commercial real estate will face cascading defaults. Regional banks may fail in clusters, and unemployment could spike from 4% to 9% or more. Bitcoin and other speculative assets may fall by 50% or greater. The dollar itself may weaken as the Federal Reserve and other central banks respond with aggressive liquidity measures. At that point, the three trades execute perfectly. Investors holding cash will have capital ready to deploy at the bottom. Those holding gold will preserve purchasing power against devaluation, and those who placed volatility bets will see exponential returns from put options, credit default swaps, and VIX calls as panic erupts. This is the architecture of crisis profits. Not mere speculation, but the methodical execution of foresight. Then comes the often overlooked implicit fourth trade, buying at the bottom. Kennedy did this in 1929, acquiring stocks at a fraction of their peak value. Buffett did it in 2008, injecting $5 billion into Goldman Sachs at the market nadir. Bill Ackman executed the same in March 2020, using the windfall from his volatility positions to buy assets while the world was immobilized by fear. This trade is the culmination of the first three. Without capital, preserved purchasing power, and profits from volatility, the fourth trade is impossible. But when executed, it is what creates generational wealth. Most investors cannot execute this sequence perfectly. They lack hundreds of millions in capital, access to institutional derivatives, or the ability to act without fear. But awareness of the pattern alone provides a decisive advantage. Even simplified versions of the trades offer outsized protection and opportunity. Trade 1. Raising cash. If your portfolio is heavily invested in equities, consider reducing exposure and holding the difference in cash or short-term treasuries. You may forego some gains if markets continue rising temporarily, but when the crash comes, that cash becomes buying power. Trade 2. Gold. Allocating 5 to 10% of your portfolio in physical gold or gold ETFs ensures wealth preservation. Physical allocation adds an additional layer of security against financial system failure. When the Fed responds with unlimited liquidity, gold's value rises, shielding you from fiat currency devaluation. Trade 3. Buying protection. Put options on broad market ETFs like SPY are an accessible approach. Select strike prices 10 to 20% below current levels with expiration 6 to 12 months out. The cost, typically 1 to 3% of portfolio value, is the insurance premium. If the crash occurs, these instruments can return multiples of their cost, providing both liquidity and profit. If the crash does not happen within the window, the loss is limited to the premium. However, the psychological component is the most critical. When markets fall 40 to 50%, headlines scream the end of capitalism, and fear dominates. Having the courage and preparedness to act is decisive. Identify companies with strong balance sheets, low debt, essential products, and market resilience. Tech giants like Apple and Microsoft, financial leaders like Visa, and consumer stalwarts like Johnson & Johnson or Procter & Gamble are examples of quality companies likely to survive and thrive post-crash. The true challenge lies in buying when everyone else is paralyzed. Panic is universal. Courage is rare. The investors who execute the fourth trade successfully are those who can act decisively in chaos. Kennedy, Baruch, Jones, Burry, Paulson, Buffett, Ackman, they shared one trait above all: the willingness to move when fear peaks. That behavioral skill is often as critical as the technical trades themselves. Looking at the timeline, we are currently in the 12 to 18-month window before the expected crash. Trades 1, 2, and 3 are in motion. Cash is being raised, gold accumulated, and volatility positions established. A trigger, whether a massive corporate default, commercial real estate collapse, or geopolitical shock, will ignite the forced liquidation and panic phases, accelerating the market's descent. Once the panic is at its peak, the fourth trade, buying assets at maximum fear, can be executed. Historically, this is when returns compound most dramatically. Positions purchased at these depths have consistently doubled, tripled, or quadrupled over subsequent recovery periods. Those who execute the cycle understand that temporary loss is the precursor to monumental gain. Understanding the rhythm of history is crucial. Crashes are not random. They are the natural outcome of human psychology and financial mechanics interacting over time. Extreme valuations, unchecked leverage, and speculative euphoria create vulnerability. Triggers ignite forced selling. Panic spreads contagiously. And the same sequence, cash, gold, volatility, then opportunistic buying, has delivered consistent results across nearly a century. This is not conjecture. These are documented outcomes repeated across multiple generations of investors, economic structures, and market conditions. While instruments evolve, derivatives replacing direct short sales, ETFs replacing individual stock holdings, the underlying mechanics remain consistent. Human behavior and financial leverage are constants. The lesson is clear. Awareness and positioning matter. You do not need to replicate every move of Kennedy, Buffett, or Burry to benefit. You need to recognize the sequence and act within its framework. History offers a blueprint. Cash shields, gold preserves, volatility instruments amplify, and opportunistic buying generates generational wealth. Ignore the pattern, and losses are inevitable. Recognize it, and you can not only survive but thrive. Let's examine why the three trades work with such mechanical precision. Every crash, across decades, follows the same sequence. It begins with a bubble. Asset prices disconnect from fundamental values, inflated by optimism and speculation. In 1929, stocks were trading at multiples that made no sense, propped up by coordinated buying schemes and leverage. In 1987, program trading and synthetic leverage created instability on a scale unseen before. In 2008, fraudulent lending, mortgage-backed derivatives, and over-leveraged banks pushed the housing market far beyond sustainable levels. Today, in 2025, the Buffett indicator, a ratio of total stock market capitalization to GDP, signals valuations nearly double what the economy produces. Historic extremes are clear. Euphoria follows. Confidence becomes irrational. In 1929, Even the shoeshine boys were giving stock tips. In 1987, market participants believed automated programs would guarantee endless returns. In 2008, Americans assumed housing prices never fall nationwide. In 2025, narratives of AI, transformative technologies, and perpetual innovation dominate investor sentiment. Fundamentals are ignored. Optimism reigns. Leverage amplifies everything. Gains become intoxicating, losses catastrophic. In 1929, 90% margin debt created a fragile market where even minor declines triggered cascades of forced selling. In 1987, portfolio insurance and program trading multiplied leverage synthetically. In 2008, subprime mortgages and derivatives exposed the system to 50-to-1 leverage. And today, margin debt hovers near record highs, creating a tinderbox of potential forced liquidation. Then comes the trigger. A seemingly minor event sparks a chain reaction. In 1929, it was a European banking scandal. In 1987, interest rate hikes combined with program trading failures. In 2008, rising defaults in the subprime sector ignited the collapse. In 2025, potential triggers abound. Commercial real estate defaults, corporate collapses, geopolitical shocks, or even a sudden loss of confidence in major tech or financial institutions. The specific trigger is irrelevant. The system's fragility ensures the cascade will occur. Forced liquidation follows. Leverage mandates selling. Prices fall not because of fundamentals, but because margin calls and liquidity shortages force sales. One investor's loss begets another's, creating a self-reinforcing cycle. Panic spreads. Stage 6 arrives. Widespread fear. Investors sell indiscriminately. Bid-ask spreads widen. Liquidity vanishes. Markets gap lower. Volatility spikes. Indexes can fall 20, 30, 40% in mere weeks, and this is why the three trades exist. Cash ensures survival, preventing forced liquidation. Gold preserves purchasing power against monetary interventions and inflation. Volatility instruments, such as puts, credit default swaps, and VIX calls, profit from panic. This combination addresses every phase of the crash sequence: recognition, preservation, and opportunity. Currently, 2025 mirrors the final stages of these patterns. Trade 1, cash, is substantially complete. Buffett's $325 billion, insider selling across corporate America, and executives liquidating stock signal a clear recognition phase. Trade 2, gold, is accelerating. Central banks globally have purchased over 3,000 tons in 3 years, a record pace since data collection began in 1950. Billionaire investors are following suit, protecting wealth against the inevitable currency devaluation that will accompany the coming crisis. Trade 3, volatility bets, is being strategically positioned. Credit default swaps on commercial mortgage-backed securities are spiking. Institutional purchases of put options and VIX calls are climbing. The smart money is ready. History provides a clear timeline. In prior cycles, these trades were executed 12 to 18 months before the peak. Applying the same window, late 2025 into 2026, represents the most probable period for the next crash. If a significant trigger occurs, the timeline may accelerate. If markets remain irrational, it may extend slightly. But the direction is inevitable. This sequence is not just academic. It offers a framework to navigate uncertainty. You do not need insider knowledge or hundreds of millions to implement a version of this strategy. Recognizing cash as protection, gold as preservation, and volatility instruments as profit allows ordinary investors to shield their portfolios and even participate in upside opportunities. When the crash hits, these actions amplify buying power at maximum fear. Preparing for the fourth trade, the the deployment at the bottom. That fourth trade, the buy at the bottom strategy, is transformational. Kennedy in 1929, Buffett in 2008, Ackman in 2020, all executed it flawlessly. The assets purchased at these low points, combined with preserved capital and profits from volatility, create generational wealth. But execution requires courage, discipline, and patience. One cannot buy during panic unless one has already protected and positioned ahead of time. Ultimately, the lesson is profound. Markets are cyclical, human behavior predictable, and financial mechanics consistent. Extreme optimism inflates bubbles. Leverage amplifies risk. Triggers spark forced liquidation. Panic devastates unprepared investors. Yet, those who understand the cycle can protect wealth, profit from fear, and invest decisively at the nadir. The blueprint has existed for nearly a century, proven repeatedly. The bottom line is simple, yet profound. The three trades, cash, gold, and volatility, are not secrets or luck. They are documented, repeatable responses to a mechanical sequence inherent in every major market collapse. 1929, 2008, and now 2025 demonstrate the pattern with eerie consistency. Each time the sequence unfolds, extreme valuations, excessive leverage, a triggering event, forced liquidation, and panic. And each time the same three trades provide protection, preservation, and profit. Warren Buffett's $325 billion cash position exemplifies trade one in motion. Central banks purchasing over 3,000 tons of gold illustrate trade two on a global scale. Hedge funds buying credit default swaps, put options, and VIX calls demonstrate trade three being executed strategically. This is not theory, it is happening in real time. The pattern is clear. The smart money is positioning. For most investors, the question is not if the crash will occur, but whether they will recognize the opportunity to act before it does. History shows that ignoring these signals leads to catastrophic losses. People tell themselves this time is different. They believe technology, central bank intervention, or narratives like AI will prevent a collapse. And inevitably, they are proven wrong. Every crash has a narrative that blinded the majority. Every crash has a minority who saw the truth and acted. The advantage lies in recognition. Understanding the pattern allows even ordinary investors to implement simplified versions of the three trades. Reduce equity exposure and raise cash. Allocate a portion to gold. Purchase protection via options or other instruments. Prepare psychologically to act decisively when fear peaks. The fourth trade, the deployment of preserved and profited capital at maximum panic, turns preparation into generational opportunity. Consider the behavioral aspect. Courage, discipline, and patience are just as critical as the trades themselves. Kennedy, Baruch, Paul Tudor Jones, Burry, Paulson, Buffett, Ackman, they all demonstrated the willingness to act when fear was universal. Without that psychological fortitude, capital can sit idle, gold can protect but not grow, and volatility bets can be mismanaged. Fear is the great divider between wealth destruction and wealth creation. Looking forward, the historical timeline suggests late 2025 to early 2026 as the critical period. Markets are currently in the late-stage positioning phase. Cash is being accumulated, gold is surging, volatility instruments are being bought. A trigger, be it commercial real estate defaults, a major corporate collapse, or geopolitical shocks, will accelerate the cascade. Markets may drop 20 to 30% in weeks, then further over several months. The S&P could fall to 3,500 or lower. Bitcoin, cryptocurrencies, and speculative assets may plummet. Gold will rise as currency devaluation takes hold. And that is the moment when the fourth trade, buying at maximum fear, creates outsized returns. Execution of this strategy requires preparation and courage, but the framework is proven. The cycle has repeated 4 times over nearly a century. The 3 trades remain consistent. The mechanisms of the crash, valuation extremes, leverage, triggers, forced selling, panic, remain unchanged. The opportunity for those who recognize it is as real today as it was in 1929, 1987, and 2008. The choice is yours. You can ignore the signals, buy into euphoria, and risk losing 30 to 50% or more of your wealth. Or you can observe the pattern, understand the 3 trades, and position yourself to protect capital, preserve wealth, profit from volatility, and ultimately buy at the bottom. History has already written the blueprint. The 3 trades have been executed. The pattern is repeating. The crash is coming. Act before it arrives. For those who recognize it, for those willing to prepare and position strategically, the next 12 to 18 months are not merely a period of risk. They are a window of opportunity, a chance to navigate history's most predictable cycles with intelligence and courage. The choice is stark, but the path is clear. The trades have to be made before the crash, because once panic arrives, it is too late. The lesson of nearly a century of financial history is unambiguous. Patterns repeat. Crashes follow mechanical sequences. And the investors who act decisively, who understand the cycle, and who prepare ahead of the crowd are the ones who create wealth that endures across generations. The 3 trades, cash, gold, volatility, are more than strategies. They are the distillation of financial history, human behavior, and the logic of markets into a blueprint for survival and prosperity. Position yourself wisely. Study the signals, protect capital, preserve wealth, profit from volatility, and prepare to act at maximum fear. The cycle is unfolding. The trades are in motion. The crash is inevitable. The window to act is now.